Good morning. Looking at the texture of the market this morning, risk-off mode clearly is back in the fray. Not just the fact that you've seen the US 10-year yield soar all the way back to that 4.3% mark, the fact that dollar as well has risen to a 3-month high. More importantly, it's been a knee-jerk reaction that we've seen to the March rate cut expectations, which clearly have now pushed back to July. That is what the bond markets in the US seem to be pricing in right now. So yes, irrespective of that green finish that we had yesterday, over 100-point gain, if we do choose to follow the global cues, so that's going to really reverse, because the global picture this morning is looking pretty weak, be it the handover, Nikunj, from the US equity markets, or for that matter, the way Asia is this morning.
Yeah, look, I mean, before we discuss local markets, it's about the global markets.
Yeah.
Now, whether it's a combination of pure, simple profit booking or concerns which are centered around where the inflation print is. Global markets were looking for a reason, and I think they've got a reason, which is that inflation print for 2024 is not looking all that encouraging, at least the first read. Now, that does not change the narrative. That does not change the trajectory. That does not change what really could be called as the general view on where liquidity is moving. But I guess global markets needed something what could be called as a news trigger, so that there could be a bout of profit booking, and I think we've seen a bout of profit booking. Now, in isolation, if you look at a 1% cut in Dow and a 2% cut in Nasdaq, it is not a very scary number. But in terms of the quantum and the percent,
the day's high point, and you had really a lot of resilience coming in from the oil and gas heavyweight Reliance Industries, which incidentally topped the 20 lakh crore market cap. So that was a support. It was the PSUs that also did a lot of heavy lifting, not to mention the Nifty Bank Index, which has been awfully lackluster off late. That saw quite a bounce back. But Nikunj, the trend that we've been seeing for the past many days is that underperformance in the broader market as compared to the frontliners.
Siavan, I'm not at all surprised with the selling in PSUs. I mean, that was long overdue, and it may have coincided with what is happening in the world. But frankly, if you look at the percentage shakeout in some of the PSU stocks, the shakeout I think is very severe, and that typically happens when there are excesses in the market. Nothing goes up in a straight line, and I think that is what has happened with some of the PSU stocks and some of the so-called weak some of the trader-dominated stocks. So nothing in terms of news flow had changed between October and December, which warranted that kind of a rise. Similarly, nothing has changed post-budget, which will warrant this kind of a sell-off. I think in terms of the approach for PSUs, in my book, should be the following. PSUs will be the outperformers. But within PSUs, just because there is a tag PSU attached to it, I don't think you should be buying them. Let's break PSUs into 3 categories. First, banks, which look cheap and which look, they're on the right side of the credit curve, they're on the right side of the cycle. Then you've got oil, ONGC, or Oil India, or oil marketing companies. They still have a lot of value left. Give defense names. When it comes to the real small tiny tunes in the market, I think that's the place you really need to be careful of. So in this decline, you need to go back to PSUs, but you have to go back to large PSUs. I like banks. I think there is a reason that you should be bullish on oil PSUs, and you may stay bullish on some of the power PSUs. But barring that, I think just because it is PSU, it does not make it a buy.
Yeah, absolutely. But let's just focus on the global handover this morning. We've got Ed Yardeni joining in on the show right now. Ed, hi, morning from India and evening to you. Just wanted to understand, it seems that the street is quite spooked about the CPI print. Now again, question marks being raised about whether it's going to be a soft landing, hard landing, and clearly the rate cut gets pushed back.
Well, I wasn't in the camp that anticipated several rate cuts this year and starting sooner rather than later. I felt that the Fed was basically getting what it wanted, and there's no reason to get in the way of success. They were getting inflation coming down, and it's still coming down, notwithstanding today's number. The year-over-year percent change is still trending lower. As a matter of fact, if you take out shelter, which is basically rent out of the CPI, both the headline and the core inflation rates are right around 2%, even now. And so why mess with success? Inflation's coming down. Rent inflation will take a little longer, but it will come down. The economy is looking fine. So I think the Fed is in no rush to lower rates. And I kind of welcome this sell off. I think I'd be more concerned if the market just melted up and went straight up.
Anything will change for 2024 in terms of forecasting?
Well, I've been bullish for a while on this market, actually since November 2022. So I've been riding this bull really almost since the beginning. And I'm thinking 5,400 for the S&P 500 by the end of this year and 6,000 by the end of next year. We were outliers with our bullish outlook for profits last year, and it looks like we're going to get a bullseye there. It looks as though $225 a share is what the S&P 500 earned. This year we see 250 and next year 270. So we think earnings will carry this bull market to higher levels.
To get in your take as well as to what the outlook is when it comes to the CPI print, that perhaps pushing for a likelihood of a rate cut maybe in the second half of 2024. But how are you looking at the overall inflation trajectory?
Well, I think that down. We know that current rents have come down a lot, so I'm optimistic that inflation is going to come down, and I'm in no rush to have the Fed be in a rush to lower interest rates. I wouldn't be surprised if we only get 2 rate cuts this year and in the second half of the year rather than anything in the first half.
Bond markets are already pricing in that probability. Ed, great to have you in the show today. Thank you so much for taking the time out.
Thank you indeed.
Okay, let's just revisit what the Nifty implied open is indicating, and clearly it seems like, we're going to fall in line with the rest of the globe. Almost a 200-point decline is what the Nifty implied open seems to be suggesting this morning. But important to set the global context, let me take it across to Vinny, find out what the global commentary is like this morning. Vinny?
Good morning. So a lot of commentary obviously in terms of the CPI data that came in terms of US. Now we have the first commentary that is coming in from Jeffrey Gundlach, who's talking about how personal consumption expenditure is a factor or data point which is much more important to see also than the CPI data that has come in. And this time CPI data he highlights that has come in hotter than expected is something that came back to bite the Federal Reserve. Other than that, he's given commentary in terms of how he is allocating his portfolio, where is he allocating. So in terms of overall, he's talking about in allocating in stocks 30% in the markets. Other than US, he's looking at 10% in Japan, 10% in India, and 10% in US as well. That's how he'll be allocating that 30% in terms of a division that he's given as well. Overall, he believes India is obviously a very strong economy. He's been quite positive on India, and in the world with the best demographics is what he's highlighting for India as a strategy to play out. Let's move on to the next commentary that's coming in from ECB's chief economist Lane, who's highlighting that there is a risk that is involved in terms of cutting interest rates too early or too soon as well. There's a risk on both the sides, whether it's early or soon. Earlier or later, there's always going to be a risk. And the current trend of inflation, yes, coming towards the mark that they are expecting, headed towards a 2% target that they have. So that's a good sign, at least, that one is seeing on that front. We have commentary that has come in from Peter Schiff, and this is from a tweet that he mentioned that even though the Fed will delay the rate cuts, rising inflation means that the real interest rates is something that will fall anyway. And that is something that they're keeping an eye out on. This is actually, he's highlighting that is very bearish in terms of the US economy and the stocks and bond markets and the dollars, but very bullish for the gold. So yes, gold, he's always been talking about commentary on how he's positive on the gold side as well. Lastly, we have Coca-Cola, which reported their numbers as well, and we have a commentary that is coming from the CEO of Coca-Cola.
Okay, let me welcome on board Kunal as well as Naresh as well and talk about how the global context, a global setup is going to impact our markets. Kunal, hi, morning. Let me start off with you. Well, yesterday was a decent day. I think today it's all going to get undone, looking at the global picture and the implied open.
Yeah, so I think yesterday's positive gain for the Nifty and the Bank Nifty, I think, should get retraced. But I think more importantly, this should now set off, the trigger that maybe this could not be an isolated correction for our markets as compared to what was happening across the globe, where the global construct was a lot more stable, if not extremely positive. But I think this could probably get the risk of mood back again from the investors or from traders specifically. Now, in the last few days, we've just seen extreme amount of volatility, but no major breach of ranges. So 21,500 broadly has been crucial support. We managed to adhere to those support levels for the Nifty, and 22,100, 22,000 for the Nifty on the upside. So I'm expecting that in the next couple of days, if in case the global construct remains a bit more dampened, then I would believe that 21,500 as a support could probably be breached.
Okay, there you have it. That's the outlook coming in on the markets. But guys, I guess we've been married too long that we've all forgotten that it's Valentine's Day today. No love for the markets as such, but not too bad. But have you got anything planned, sweet plans for your...
Considering you were MIA for
yeah,
last whole
now
week.
you have to make it up.
Weekend
Have we
plans.
reminded you?
No.
I totally forgot.
No. I mean, these are basic things you don't forget. I mean, important key for a happy marriage.
Yeah.
But yes, I mean, by the way, somebody texted me that there is also Basant Panchami today.
Happy Basant Panchami.
That's the Hindu tradition, which is what we should focus more on.
Okay, Naresh, let's get in a take from you. No love for the metal sector whatsoever. That sector really underperformed, but I think banks more than made up.
So we are continuing to see one day up, one day down on the bank nifty as such. So over the last 4 days, we've had this one day up, one day down. Yesterday, we saw a strong recovery. And today, thanks to US markets, we'll see some bit of a dip today. So overall, we are still stuck in that band. We are not able to get out of the 21,400, 600 on the downside, 22,100 on the upside. We've seen small caps yesterday correct and made a good recovery also. So overall, we are in this period where we try to find a base where it could be closer to 21,400 or 21,200. But the structure still remains of a consolidation rather than a sharp correction. Globally also, it's just been a couple of days of correction. So we need to see whether it can see a major follow-up going forward. So overall, we are in this zone where one has to be more defensive, continue to look for stocks which are showing relative outperformance. Metals as a pack overall still looks pretty promising, wherein you have stocks like Vedanta, which has gone. Not be the same case with other names. So overall, time to be more, defensive and keep looking out for stocks on dips and showing relative outperformance.
Okay, let's talk stocks as well. Naresh, what's on your list?
So I'll continue to like first a buy on Maruti, which has shown a lot of relative strength. The stock continues to hold on. Overall, the stock had last made a top around 10,000 in 2018, and that got tested multiple times over the last 5-6 years. Then gave a breakout, then made a move towards closer to 11,000, did a retest of 10,000. And now we are starting a new leg. It should get it further into momentum once it crosses 11,000. So at current levels, the risk reward still looks pretty interesting. Stop loss at 10,400, target price of 12,000. Second is a buy on State Bank of India. On this gap down, it could be a good entry point. The stock has broken out above the 660, 670 mark. The only stock out of the banking names which has clearly shown a leadership move and has continued to hold on for the last few sessions as well after the breakout. So any dips today to 690, 700 should be a buying opportunity with a stop loss at 680 and initial target price of 740.
All right, let's get stock-specific, Kunal, as well and find out what you're picking out.
So I'll pick up two sell ideas. The first one is a sell on Bajaj Finserv. That's a stock which is nearing its break of 200 moving average. So I'm expecting some further correction to the stock. 1530 as a target. Stop loss revised to 1590. And the second will be a sell on India Cement. The stock has gone through a corrective phase. It's completed a bearish flag pattern on the daily charts, breaking below the 235, 236 support of this flag pattern. So expecting a further continuation move on the downside. 223 as a target for India Cement. Stop loss trail to 238.
Okay, let's move on and let's talk about the newsmakers then this morning. And Samit is here to flag off some. Samit, I know we've got PSUs to discuss, but let's first address Eris Life Sciences. What are the results like?
The numbers were pretty much in line with what the street was expecting, but the bigger announcement has come in on that big acquisition that the company announced. Now they are acquiring nearly 51% stake in Swiss Parenterals for a consideration of close to 640 crore rupees. Now of the 640 crore, 200 crore will be an upfront payment, while the remaining 440 crore rupees will be paid by the end of 1 year post the completion of this deal. And this deal is expected to complete by the end of this financial year, that is FY24. Now apart from this 51% stake, Eris promoters will also be acquiring another 19% stake in the company, while the remaining stake will be held by the existing director of the company and he will be running the operations of the company going forward. Now, apart from this 640 crore rupees, Eris will also be investing close to 40 crore rupees in the company to develop its manufacturing plans, and some front-end work also needs to be done. Now, as per analyst, over a 2-year basis, that is FY25 and FY26, this deal is clearly EPS neutral and nothing much on the EPS front, but overall I did all these acquisitions well in the company, and this has been one of the key strategies for Eris Lifesciences, that is to acquire and grow. Now, all these acquisitions have been done at a range of anywhere between 275 to 640 crore rupees, but the valuations, if you see, have been pretty much attractive, anywhere between 3.3 to 4 times the sales value. Now, given the guidance what the company has given, also the guidance has come in positive for Eris Lifesciences. Now, for FY25, they are clearly showing a 35% revenue growth. Their FY29 revenue guidance of 5,000 crore rupees clearly depict a growth of around 20% CAGR over FY24 to FY29. And on the debt front also, if you see, the company is saying that they will keep that debt to EBITDA at the range of around 2 to 2.3 times, despite the acquisitions that they have done currently, and even going forward, even if they do any acquisitions, that debt will remain range bound within 2 to 2.3 times, which is also coming in as positive for Eris Lifesciences.
You've said it all, my friend. Very little which I can actually add from valuations to. No, I don't track this one, but I mean, I buy what you're saying in terms of the whole fact that if the acquisition goes through, let me put it this way, the construct of the market, the construct of the company would be different. The problem is that very few pharma acquisitions have worked in the past. So I really hope that they're trying to do something which is right, because with the exception of 1 or 2 acquisitions at a global level, very few strategic acquisitions in the pharma sector have actually created a lot of value, whether it is Cipla, whether it is Lupin, or even for that matter, Sun Pharma.
Okay, there you have it. That's Eris. But that aside, it's clearly those PSU stocks in the spotlight, and Jeffrey is coming out with their view, talking about their top bets, which, Samit, you can highlight, and saying that the re-rating has more legs.
Well, yes, contrary to what the market view has been, that PSU rally is overdone, Jeffries has come out with this note where they're saying that there are more legs to the re-rating that we have seen in PSUs. Now, they're saying that in the past 12 months, PSUs have outperformed the Nifty index by around 70 percentage points, and but this outperformance has come after a decade of underperformance prior to 2020. That's what the highlight of the note is. Now, they're also saying that the recent outperformance was helped by the ROE improvement and also because of the EPS upgrades that we have seen for many PSUs. Now, they're saying that PSU ROEs had dipped from 14 to 15% level earlier to 4 to 6% level. However, this has now improved again to around 12 to 13% on the back of improved profitability, and because of this also, if you see, a lot of EPS upgrades have come in for PSUs. Now, they're saying that notable EPS upgrades have come in for many PSUs except for ONGC, Container Corp and BHEL so far. Now, apart from that, they're saying that the index still trades at a 40% discount to the benchmark, and this offers a 15% re-rating at least if you want to achieve that average levels of discounting compared to what the Nifty benchmark was. Apart from that, the governance levels has improved. Also, the
So, if one looks at even Coal India has a long way to go. The PSU stocks have got re-rated, and they are the leaders in the market. The problem are smaller PSUs, some pockets of fraud in defense PSUs, and a lot of railway stocks where I think the price action just not justify the growth. If you take that part out, State Bank is still trading at a price to book which is less than 2 times. NTPC is still one of the cheapest power utility. If one looks at Coal India and ONGC, they have huge advantage in terms of some monopoly pockets. So if you make a basket of 4-5 large PSUs all across the sector, I think that would be a good approach. What you need to avoid is that just because some of the railway stocks and some of the smaller PSU stocks which had gone up in this rising tide phenomenon, you don't want to buy them. You don't want to sell all PSU stocks, but what you want to do is that you want to shift maybe some of your allocation in smaller PSUs to large PSUs and stick to the 4-5 names, at least in the run-up to the budget.
Okay, thanks very much, Samit, for highlighting all of those stocks in news and, of course, the PSU sector as a whole with Jeffrey's note. Well, moving on, the Prime Minister Narendra Modi is in Abu Dhabi for his 2-day visit to the UAE. He was accorded a guard of honor and received by the UAE President Mohammed bin Zayed. The Prime Minister thanked the UAE President for the construction of the first ever Hindu temple in Abu Dhabi ahead of the inauguration. The Prime Minister also took the opportunity to introduce the UPI RuPay card services in Abu Dhabi, addressing India as well as UAE relations and the significance of IMEC in his opening remarks. Listen in.
भारतीय का लक्ष्य 2047 तक भारत को विकसित राष्ट्र बनाने का है। दुनिया का वो देश जिसकी अर्थव्यवस्था बहुत तेजी से आगे बढ़ रही है, वो देश कौन सा है? हमारा भारत। दुनिया का वो देश कौन सा है जो स्मार्टफोन डेटा कंज्यूम करने में नंबर 1 है? दुनिया का वो देश कौन सा है जो ग्लोबल फिनटेक एडॉप्शन रेट में नंबर 1 है? हमारा भारत।
Back with the market right here in 80 now. Given the global handover, it seems like we too are going to fall in line with the rest of the globe. And that move and recovery in the market yesterday is going to clearly get undone. The GIFT Nifty, although the settled move is indicating just a soft start for us, it's not as much of a gap down as you had in terms of US handover or how some of the Asian markets are panning out this morning. But let me welcome on board Sanjeev Bhasin and find out what best to do in a market scenario like this. Sanjeev, hi, good morning. What's the market strategy for the day, given what's happened in the US markets and how Asia is following it up?
Yeah, good morning, Aisha. Well, it seems to be an excellent opportunity. The US market had not corrected. And even if the inflation number had come in line with what people wanted, it still would have corrected. It was a much overdue correction. Now, 2.9 going to 3.1 is only macro, and economists will make hay while the sun shines. The undertone remains that the US is in a strong position as far as their soft landing goes, and rate cuts will always be speculated. The RBI gave you a clear indication there is nothing much on the anvil. So I think the humdrum of a fall in the US of 500 points was much overdue. We have been already in on a place where the large mid caps have been consolidated. EBITDA up 66% and margin at a 10-year high, 23.5 against 14. So, the real value lies in the eyes of the beholder. I think PSUs are in for a big re-rating, but be it State Bank, be it ONGC, be it NTPC and NALCO. So we are finding places where use this dip to buy and ignore the noise, because the noise will always be murky. When they were going to new highs or 5,000 on the S&P, you didn't cross 22,000. So be it. So I think there will be some range-bound correction, which will be an opportunity to buy, Aisha.
Okay, lots of other stocks in focus, and yes, Nalco has had a blowout set of earnings. In fact, the net profit itself has seen an uptick of a massive nearly 84%, 83.6% on a year-on-year basis to be precise. So look out for what that stock does, even after the 80% run-up that it's had in the last 52 weeks. There's also Z, which is going to be in focus. I mean, the earnings came out yesterday, and reacting to that, CLSA is maintaining its sell. They've cut the target price further now to 175 from the earlier 198. In fact, after the muted numbers, let's hear out what Puneet Goenka, the current MD and CEO, had to say.
Personally offered several proposals and solutions to Sony to address their demands, but unfortunately they remained unaccepted. Since the matter is sub judice, I would not like to say more and let the law take its own course. I want to take this opportunity to reiterate that Z continues to have strong business fundamentals. The company,
valuation. Disney has just been upgraded to over $200 billion market cap. So continue to be painful, both Z and Paytm. But, that's part and parcel of investing. Some things are uncanny because of the incidents, but we think there will be a resolution faster than you thought. And as soon as you see the back of some of these large promoters who have misled investors, I think this stock can be re-rated. It's difficult to comment till we get more opinion on the legal case with the NCLT and the courts. So I'll keep my observations till there.
You nudged me on Paytm, and while they continue to face that serious risk of customer exodus after the RBI curbing on its payments bank, Sanjeev, yesterday you had Macquarie cutting the price target all the way to 275. Considering that you have a holding here, have you exited Paytm completely?
No, no, Aisha, we remain firm. We think that there will be more color. Obviously, Macquarie is giving a technical call, which is, increase the fear, similar to what he had said, 2200 on HDFC Bank. So either of them will come correct. And congratulations to him on the fear call and the greed call. But we continue to remain positive that there will be a resolution. Now, we know the lacuna, but that is more to do with how RBI and the fintech in charge try and rectify that. Yesterday, if you heard Axis Bank, they said we will be very, very thankful to RBI if they allow us to align with Paytm. So let me tell you, there are a lot of people who are just waiting to grab the asset or get into a license, because this is the father of fintech has been Paytm, and I think there will be a resolution. We cannot comment more. It is painful, like I said, but we have to sit through. Good opportunities and bad times don't come together.
In fact, our reporter has been tracking the Paytm saga pretty closely, and it seems that they're in talks for expanding business relations with other lenders as well. We're learning that the parent company, that's 197 Communications, is in talks with at least 5 lenders.
Wider banks. Now, this means that wherever Paytm Payments Bank was a partner for 197 Communications, they want to replace it with other lenders, and for that there has been meetings. They have reached out to banks, and these banks include ICICI Bank, HDFC Bank, Axis Bank, Canara Bank.
So my view is simple, which I'm maintaining from day one, that if you buy a Paytm right now, it's like catching a falling knife. You don't know which way things would move. It is better to buy something where you are clear about the regulatory action, but trying to second guess what the regulatory action would be. Well, I know that good news and good price, it rarely comes together, and bad news and good price, it always comes together. But in case of Paytm, my view is that whatever is going to happen, even if they come on the right side of the regulatory action, the numbers for FY25 would be very different from what markets were assuming. And that, for me, it means that the path to profitability for Paytm is actually going to get more and more, extended. B, fintech is also about talent. And when a brand takes this kind of a punch, will they be able to attract a lot of talent? Paytm, Zomato, these are companies which are essentially innovator companies. Innovation is about talent. Talent is about comfort. Talent is about brand. And when you see Paytm and Baiju, when they lose a lot of brand appeal, then talent does not come in. And when talent does not come in, it's always a challenge going forward when it comes to innovation. Paytm has always innovated because they had the great talent. But will they continue to do that same pace of innovation? And if they don't come on the right side of the regulation, or if this entire saga continues for next 2 months, 3 months, I don't know what will happen to the stock, because every time my fear is that the stock will go higher. The supply actually from global investors, and especially the P folks, and especially some of the old timers, I think is going to be there, because that in a sense becomes a eyesore for them, especially when it comes to ESG and other corporate governance. So that's my view, Sanjeev. We may agree to disagree, but that's my view, that when a brand takes this kind of a hit, both from a governance standard, from an institutional standard, and from a talent standard, there are long-term challenges which come up.
I fully agree with you, Nikunj. Like I said, it is best to wait and watch as the drama unfolds, buy it higher, but let more clarity come. You've seen 3 episodes like that, and where the over ownership by FIs always drives like a herd mentality. You saw the first case is HDFC Bank. It's still not recovered, despite being the largest mortgage lender and real estate in the best place ever. All your questioning is now HDFC Bank's efficacy to increase margins and credit deposit. For God's sake, when a bank is trading at 2x price to book 1 year forward in once in 20 years, this is the time you can't get opportunity again. But like I said, the dumb money has been only chasing HDFC Bank as a prima donna for the last 3 years. And that is what has upset the apple cart, because suddenly Nalco, SAIL, REC, PFC are up 3 times. So allocation of funds, dependence on one stock any other mortgage lender rather than HDFC or the bank as a whole.
Again with HDFC, why is it suffering? Because they've changed the guidance. Secretly, 4-year doubling now suddenly becomes a 5 to 6-year doubling. And that means that instead of 17-18% growth, they will be growing at about 12 to 13%. Now that's a 5% change on that kind of a large base, which means the promise that after the merger they will double in 4 years could actually happen in 5 or 6 years now. And that's what markets are telling you. That why should we give you this kind of a premium and this kind of a comfort where HDFC in a sense had a reputation of under committing and over delivering. That was Aditya Puri for you, but Shashi Jagdishan has not lived up to that. And that I think is the most puzzling point, that why did the management did not foresee that this kind of a growth is going to be slowing down. I mean, if the economy would have slowed down, I would have argued that okay, it is a macro problem, but there is no macro problem. I mean, it's your assumptions and it's your calculations about HDFC which you thought is likely to grow, and it is actually not growing. But I'm going to just move away from these two stocks which in a sense have been painful stocks to something where wealth has got created. And a lot of wealth, Bhasin Saab, has got created in railway stocks. All you had to do is like close your eyes and throw a dart and railways, and ticket nahi mili, waiting list mein train hai, does not matter, but as long as you put a railway stock, you've hit out of the park. Would you buy railway stocks in this decline?
Well, we booked out of some of them, particularly IRFC, RVNL, but we will look at opportunities. However, like I said, if NALCO numbers are good, why should I keep chasing stocks or sectors just because they've corrected? I am very positive on NALCO, ONGC, and you can add an NTPC there. So I think we will build our book over there. We think that PSUs have just seen a glimpse of re-rates. We think NALCO can be a doubler from here, if not very, very fast.
Read into the outlook on Eicher Motors. It's been a record performance that they have delivered in the quarter gone by. The volume growth as well has been steady, Sanjeev.
Well, Avan, you can see Hero's touched 5,000. Bajaj is almost on the cusp of 8,000. And Eicher, which was touted at 4,000 to be come out with brilliant results, has suffered more to do with the launch of the Harley and the Triumph by both those competitors. That has hurt Eicher rather than the earnings. I think the earnings were in line or better. But like I said, these are the weightage of stocks which you will give. Rural income still continue to be very, very strong. And I think that Hero and Bajaj, which have been two of our picks, will continue to outperform. On Eicher, we have a neutral rating, given that we will see how the competition bites in and how they are able to respond. I think Siddharth Lal has been an exceptional leader, but right now he has competition up his sleeve. So we will give that a miss. We think Bajaj and Hero in our portfolio are the best.
Speaking of the auto space and Eicher Motor in particular, let's hear it out from Siddharth Lal, the MD and CEO of Eicher Motors, who spoke about some of the new launches and the milestones that they've achieved.
The all-new Himalayan, first and foremost, which is on the all-new Sherpa 450 engine. This was done in Goa at Motoverse. The new Himalayan has set absolutely new benchmarks in the world of adventure touring across all markets. So it's been, the reception from consumers, experts has been absolutely amazing. And we've won the extremely prestigious Indian Motorcycle of the Year award for 2024, which is our fourth IMOT win in the last 6 years. And we won it in 2023 for Hunter, 2024 for Himalayan, so it's consecutive win as well. But it's a 4th out of 6, and really it's a testament to the strength of the new products that we're coming out with in the last many years.
Hemang Jani joins us. Now, Hemang, what's your market view? Do you think we still have some more frothiness left which needs to be cleansed?
Morning, Nikunj. I think markets have been showing a lot of volatility in the past few weeks. VIX also had gone up, by almost about 8 to 10%, 16 or thereabouts. And we are seeing now increased volatility coming through from the mother market, US markets. So I think we should be bracing for some degree of volatility. I think it is quite normal and part of the market cycle. particularly in pockets where we had seen exuberance, froth, be it PSUs, be it the broader universe of mid cap and small cap. So I think it would be good to go through some degree of correction, some degree of consolidation, and that will throw up more opportunities for everybody.
Specifically on Hindalco, post the earnings, what's your view? I mean, is it a good time to revisit Hindalco?
I think Nikunj, the way the Novelis expansion, news hit the market, that was a major setback. Also, the fact that we had seen a bit of a revival in the metal space, but when we look at the numbers, not just Hindalco, but the broader universe, there is some degree of disappointment. So, some of the private metal companies like Tata Steel, Hindalco, Jindal Steel, JSW, etc., or the PSU universe. Now, having seen that kind of a run up, when you look at the numbers, particularly, let's say the PSU metal companies, there is a clear-cut case of, that market was far too exuberant and the numbers are falling short of expectations. And also, when you have a scenario where the US markets could go through a little bit of corrective phase, not much of clarity coming from China, I would not be comfortable buying into the metal companies at this point of time.
Okay, fair enough. Meantime, let's just also get in your take then as to how you're reading into Reliance Industries. The trajectory as well has been fairly strong, 20 lakh crore market cap. That's a milestone that it achieved. Where is it that you see of all the businesses that the company operates in, the real delta coming in for Reliance Industries?
So, Aman, when we look at Reliance, only in the last maybe couple of months, we've started seeing a bit of a catch up. The numbers were reasonably good. What we like about Reliance is the fact that the Jio business is shaping up pretty well. Our pools are showing steady increase. The retail business also by and large is doing well. Oil and gas, you have a little bit of commodity-driven data points which are a little bit patchy. But because of the significant underperformance by Reliance, also the fact that the large caps as a space will do a little bit of catch up. So within that theme, Reliance is surely fitting in, and it has started showing that also in the stock price movement. So we would be very positive on Reliance at this point of time. We see a case for a 18-20% kind of a upside from current levels.
Okay. Are you, which side of the fence are you on when it comes to the entire PSU space? Because some of the market men are of the view that there is still more steam to go, that anything that has the backing of PSUs will only continue its wonder run that it had last year. Are you turning a bit cautious?
So my reading is that when people start taking a 10-year view on a PSU theme, and when people start raising big time money, giving that story, you will go through this kind of turbulence or volatility, whatever you call it. Having said that, I think you will have certain opportunities wherever the numbers have been good. So, for example, be Petronet LNG or GAIL, to some extent, I think Nalco numbers were good, but our view on metal is not so positive. Also, PSU banks, when we look at it, the numbers by Canara Bank, PUB have been stocks on their merits in terms of their earnings and valuations. And from that perspective, I think some of the names that I have outlined, we have a positive view over there.
Speaking of PSUs, we also interacted with Quant Mutual Fund Sandeep Tandon just yesterday, and he says that he continues to maintain a constructive stance on the PSU pack. Let's listen in.
We have been talking about value as a thesis, and obviously PSU qualify as a value thesis right from September 2021. So it will not be, we were relatively, as compared to somebody is looking at the top, we are very early in identifying that inflection point, and I've been very bullish for last more than 2 years now in this space. So but we remain very constructive. If you look at the larger picture, we are looking for the PSUs, okay? Neither we get too complacent about the move which we happened very recently, nor we get too tense about what happened in last 2 or 3 trading sessions.
There are two stocks which are worth revisiting, and Himang, you understand this business. Nuvama Wealth, excellent set of numbers. IFL Wealth or IFL 360, the new name now. 360, right? IFL 360, yes. IFL 360, right? That's what you call it.
361 is what they call it, no?
360 होगा ना?
361 is, yeah.
The 360 and 1.
Yeah,
Oh, I
it's
didn't realize.
360 ONE.
ONE.
Oh yeah. I mean, in terms of normal culture. No, it's terms of normal culture. Yeah.
Normal
But it's
yeah.
not 360. It cannot
You
be
call it
361
360.
degrees.
No.
It has to be 360 degrees. Goal से ऊपर क्या होगा? 360 is full circle. You cannot have full circle and then you start at 1.
Absolutely.
361. Thank you, Kunal. Okay. Now that we've got our maths and geometry right and the name right, Himang Jani, Wealth Management Company.
You're looking at some of the auto names.
So I think from the cement pack, UltraTech Cement has been one of the few stocks which is still holding its ground above the 9,500 mark. Now, interestingly, many of the cement stocks have gone through a correction. I think UltraTech Cement has gone through a range-bound action. So in the last 1 month, end of December, for example, the stock had started off its journey about 9,600 levels, breaking past about 10,000, 10,400. I think that was a high the stock had made early January. And right now, it's come back to that 9,500, 600 mark in terms of a support. So I would believe that it's more of a range-bound action for the stock. We'll see how the stock takes support at the 9,500 mark. If it holds on to those levels and assuming if the sell-off gets arrested, then we could be looking at a further rise back again for the stock. From the auto pack, I would still believe that the likes of Hero MotoCorp, Tata Motors, they still look very attractive. Maruti is a fresh addition in terms of a breakout. And interestingly, the stock has not corrected in the last 3-4 days of this heightened market volatility. It's still remaining at 10,700, 750 levels broadly as a pivot. So I'm expecting that if in case there is any kind of a cool-off, a minor cool-off for 200, 250 points for Maruti, say 10,500 levels, that could be a very good zone to try and enter into the stock.
Okay, that's autos and cement from Kunal. But let's move on then and track more news and updates. We're learning from sources that SEBI has decided to continue the abeyance of Manappuram Finance subsidiary company Ashirvad Microfinance IPO. Let's get in all the details, and Ankur Mishra joins in to fill us in. Ankur, what's the update with respect to the IPO?
Yes, sources say that market regulator SEBI has once again kept Ashirvad Microfinance IPO in abeyance, and we understand that has been kept because there has been queries which were raised by the regulator. We also understand as per company that this is part of a regular procedure because sometimes when regulator asks key questions about the IPO, the company comes out with details to the regulator, and this usually takes usual than longer time ahead. Remember, this IPO was filed in the month of October as far as DRHP is concerned, and after that the approval of regulator was awaited for further proceedings. But till now we understand that regulator has not cleared the IPO and it has been kept in abeyance.
Well, good morning if you've just joined in. Well, the news is that yesterday we did see a big recovery in the second half of the trade. Now, will that recovery get challenged today? Well, global markets are telling you that hold on, bulls, you still have some more days of hibernation. That's the intraday rally. If markets would have closed if US markets were stable, if the handover from Asia was not that bad, then I would have made a case that markets would build it on. But will we realistically get jammed because of the US market? And my point here is that US markets are down because of inflation and inflation uptick. But Indian markets have rallied despite inflation concerns or despite US inflation concerns. We've seen that in 2022. We've seen that in 2023, where when inflation print was high, and even if rates were moving higher, Indian markets actually rallied. So in isolation, you can look at today's market and say, okay, US markets are down, inflation is high, Fed is going to push back rate hike. But that's not going to change the narrative, because the narrative for India is very different. It is not centered around US inflation. It is not centered around US flows. It is centered around what's happening here, where our rates are moving, where retail flows are moving. What is dominating, Himang, are retail flows, not FII flows. And frankly, the retail average Joe does not really track US inflation and then take up their mind to start their SIP or not stop their SIP. That's my limited point, that we should not read too much into the entire inflation data. Hemang?
Very well put out, Nikunj. The only thing is here that because we've seen a sharp run-up both in US markets and India, you will go through a little bit of, volatile phase. Sometimes there is a tendency to average out and, buy something which was purely going up on momentum. So those are the things that we have to just keep in mind. Otherwise, I don't see, change in the stance when it comes to the overall market. More so, the Nifty or the banking stocks which have not participated in this entire, run up that we have seen, I think we will get extremely good opportunities over the next days and weeks.
Okay, Hemang, great to have you on the show. Thanks as always for joining in. Hindalco, that was the big news maker after Novelis's numbers and of course after its earnings as well. We're going to be chatting with the management as well just shortly from now. But let's also get you all the buzz and cover on D Street. TCI Express, it seems, is the one in focus on account of its automation timeline. We've got Sharad here with all the buzz. Sharad?
In focus, we are having TCI Express, and the cover on the street is that the automation center for Pune is expected to become operational by the end of March. Now, importantly, channel checks suggest that cities such as Mumbai, Chennai, Kolkata and even Ahmedabad are the places where it's on the cards that the automation centers would come out. And when the automation centers come, they are expected to increase the margin profile of the company. If you look at the overall performance, the volume perspective of it, the third quarter was weak because of delayed festive season, and our channel checks also suggest that the fourth quarter is also expected to be on the weaker side. Management has given a guidance of 11 to 13% volume growth in FY25 itself, and importantly, the stock itself is down almost 28% from its 2023 level high levels. But do remember, Street is bullish, especially because of the experienced management there. And importantly, the Bloomberg numbers we checked from the analyst perspective, 80% of the 15 analysts tracking the stock still have a buy or a hold rating in the stock, and a combined 12-month target price is set at 1,394 rupees per share. Now that indicates roughly 15% returns from the current levels.
This will just come up for you on your screens. But, the interesting number today is going to be Sula Vineyard. With all the buzz around...
The envelope calculation suggests that for the project to generate low double-digit IRR, the project would need initial profitability of about $900 to $1,000 per ton, which looks slightly difficult. So, should we expect the IRR guidance to be lowered further?
Absolutely not. I will not comment, but just say that you are in the right ballpark. We have actually got contracts that are signed that make us very comfortable that because remember, most of the Bay Minette capacity already has got contracts signed. So we are fairly confident that we can deliver the double-digit IRR with the contractual pricing that we have already committed.
Right, Satish, analysts also fear that, by the time the plant is commissioned, aluminum upcycle may actually turn unfavorable. Do you also fear this?
Absolutely not, because the aluminium price really does not impact Novelis. It's the price of conversion into can body and auto that impacts them. And if you look at the can body demand and the auto demand, the industry has already, our customers have been doing their analyst call and talking about, on the can side, a 3 to 4% CAGR over the next many years. And on the auto side, it's more like 7%. So I think the demand for aluminium going forward is going to be very strong. And I think that's why there is no worry in our mind that this product will not get sold.
So given a massive 65% cost increase for the Capex project, which was complete abandonment considered, if yes, then what factors the management finally concluded that they actually want to go ahead with this project?
It's a good question. I think what I'll have to tell you is that this is a very strategic project for Novelis. Novelis is the world's largest rolling company. They have the biggest market share in many parts, including the US. The US market today is undersupplied and is actually importing can body sheet from Asia and China. Our customers wanted us to put this capacity, and hence to preserve our market leadership and our presence in the US, we had to do this greenfield project, which is so large, and putting up a hot mill and cold mill. So that's the first point. Strategically and to meet our customer demands, we have to do the project. Number two, this is phase one of the project. The phase one is double-digit IRR. The phase two will be higher because the capex intensity to double from 600 KT, the capex intensity is going to be around $1,500 to $2,500 a ton. The phase one was at $6,800 per ton. So the returns profile of this project going forward is going to improve further. So which is why we think that it's very important for Novelis and Hindalco to do this project still in spite of this capex increase.
EBITDA per ton has come in at about $499, right? At the upper end of your guidance, and that's clearly been impressive. But you've guided now for $525 per ton for Q4 and 600 EBITDA ton over time. How soon do you expect to touch that $600 per ton mark?
No, I think that, for next year, we will stick with the 525 and slightly going up. The $600 per ton will take a couple of years because many of the new contracts and pricing that we have put in place has to come in. So I think that it's fair to say in a couple of years, we'll get to 600. And next year, we are guiding at, around and above the $525 per ton.
So let's now talk about India operations. Although the revenue performance was flat sequentially, margins have expanded to about 9.5%, about 10% from 8.5%. How essentially or how do you think the cost trends actually have developed?
So I think in Q3, as you said, the input costs, which is CP coke, coal, those prices came down. So our cost came down by about 3.3%, which is why the margin expansion happened. I think that in Q4, we are guiding the market to say that our costs are going to remain flat with Q3. So any margin expansion there will need the LME or the price of aluminium to go up.
Right, and consolidated net debt, that's declined 7% sequentially at the end of Q3. Now that capex cost is expected to rise over the next 3 years, how much could debt increase by, and when will you think the debt position finally peak out?
Contraction here. So once it sustains above 1770 would be a good breakout. So risk reward trade, preemptive in nature. So a buy with a stop loss at 1680, target price of 1900.
Kunal, what about your mid-cap ideas?
Well, that'd be a buy on Poonawalla Fincorp, a stock which I've been bullish on earlier. Looks attractive even at current levels of 475, 480 where the stock closed yesterday. The parameters in terms of technicals are still strong. The stock is still holding on to its key long-term moving average support, 200-day moving average, as well as the 100-day moving average. So would suggest a buy with a target of 520 and stop us at 460.
All right, let's get a move on and tell you a little bit more about the editor's take. Jefferies came out with their latest note on the PSU sector, saying that they believe that there could be an outperformance going forward. Let's listen in to what Nikunj has to say.
Banks are looking good. Large PSU franchise like Coal India and NTPC still has a long way to go. And perhaps if one looks at even Coal India has a long way to go. The PSU stocks have got re-rated and they are the leaders in the market. The problem are smaller PSUs, some pockets of fraud in defense PSUs, and a lot of railway stocks where I think the price action just does not justify the growth. If you take that part out, State Bank is still trading at a price to book which is less than 2 times. NTPC is still one of the cheapest power utility. If one looks at Coal India and ONGC, they have huge advantage in terms of some monopoly, pockets. So if you make a basket of 4-5 large PSUs all across the sector, I think that would be a good approach. What you need to avoid is that just because some of the railway stocks and some of the smaller PSU stocks which had gone up in this rising tide phenomenon, you don't want to buy them. You don't want to sell all PSU stocks, but what you want to do is that you want to shift maybe some of your allocation in smaller PSUs to large PSUs and stick to the 4-5 names, at least in the run-up to the budget.
All right, let's find out what those index calls are. Here's what our chartists are advocating one should do with the index. And it's a unanimous no trade, according to both Naresh as well as Kunal. This despite the fact that we did manage to attempt to pull back yesterday. But I guess the global cues are indicating that it could be a bit of a soft start. And no trade as well when it comes to the Nifty Bank Index. That's the view from our chartists.
Okay, just counting down then to the market open. Kunal, we just heard from the Hindalco management. The pre-open rates are suggesting that there could be a bounce. But given how oversold and whacked out the stock yesterday was, do you see a meaningful recovery coming in on the charts?
Well, that will depend, Isha, if the stock manages to cover the gap down which it traded yesterday. So we've seen so many number of times that, stock post a sharp gap down would get into a rally or a smaller phase of rally. But then these stocks,
lakh crore rupee addition has happened, I think, in just the last 2 weeks alone. Do you think that could provide some comfort to the market today?
So Reliance continues to be in a steady uptrend. You want to be looking at buys on dips to 2850 to 2800 levels. Overall, the trend is pretty positive on that one. The next target price for the stock would be closer to 3200. And you need to add the fact that Geo Finance came out of this. That's another 270 rupees. So that's a addition on the Reliance market cap overall. But Reliance as such has been the torchbearer in terms of the current move. It's gone up from 2650 over the breakout towards 2930 mark. So once it crosses, say 2980, that could be further momentum in the short term. So for now, a buy on dips to 2850 or add on momentum about 2980.
That's the view coming in on heavy hitter of yesterday's trading day, that is Reliance Industries. Meantime, just wondering where you stand, Naresh, when it comes to some of the stocks within the, some of the metal stocks, owing to the fact that yesterday you had a meltdown literally that played out within the metal space. What are the charts looking like?
So the stocks which should look interesting is SAIL, which has corrected from 145, 150 a few days back, down to 115, 118 levels. So closer to 110 to 115 is a very strong support. So this is the zone you want to actually accumulate SAIL, which has corrected quite a lot. The next one is if you look at something like a Nalco, which if from 165 has corrected to 140 odd levels. So 140, 143 looks like a good entry point on any dips. And the last one being Vedanta, once it can cross above the 280, 285 mark, that could be very interesting, which has created a strong base around 255, 265. So this dip could be the time to look at metals as such.
Okay, it'll really be all about PSUs today as well. Good numbers coming in from Nalco, well above the market estimates. The expenses have been lower on a year-on-year basis. NBCC has come out with its numbers. The EBITDA has seen an uptick of about 23% on a year-on-year basis. Margins have seen an expansion of 40 basis points. IRCTC also came out with its numbers. The EBITDA has scaled up by 21%. The tourism business revenue alone has seen an uptick of 37% on year-on-year basis, and most of these stocks are reacting positively to their numbers. What's not going to do well, I guess, is Sula Vineyards, because while the margins have come in higher, there's been a slight moderation in the revenue growth. So look out for what that stock as well does. There's Gujarat Gas also, wherein the EBITDA has come in lower by 19%. ZB already flagged off a revenue downtick of nearly 22.5%. And then, of course, there's RCF as well, much in line with its rest of the chemical and fertilizer peers. The numbers are a disappointment there as well. The margins have slipped all the way to sub 2% versus a comparable of 7% in the same quarter last year. So a bunch of these stocks are going to be in focus. And yeah, I guess today we're going to fall prey to the global handover.
I get a sense, Aisha, that you will react to the global setup initially, and then you would say, okay, we've not reacted to inflation, and then it's time to move on. Frankly, it's not the US inflation which is driving markets. So why should that be a concern? I mean, wo hamara inflation, it is their inflation. So why should that be, having a numbing factor on the market? Markets were looking for a reason to correct. They've got one. We preempted the fall. The weak hands have shaken out. So I don't see a sizable downside per se unless something really dire happens. So the market downside will be limited and restricted. Buy on bad days, sell on good days. I think that really has been the theory. That really has been the basic approach, and I think in all probability it will continue. First rates, it will be a lot of red on the screen today, so that is going to diminish all the recovery what we saw in the second half of trade yesterday. So it's across the board actually. IT would be the first one. I think Nasdaq is down 2%. That means IT is going to be down. Without even looking at it, I can say. Let's look at IT. Down 2% the index. Infosys, TCS, Wipro, LT Mindtree, Tech Mahindra, HCL Tech. Everything is down. Now let's look at PSUs, PFC, REC, the entire BHEL, railway stocks, and then let's not lose sight of Paytm.
Payments by the central bank. Manappuram gaps down about nearly 3% in trade. Couple of other weak numbers, not just Z like Nikunj flagged off, but MTAR Technologies as well. The net profit has seen a sizable dip. It's a downtick of nearly 67%. MTAR should be gapping down as we speak, 10.5%. That's a severe damage on this particular stock. Sula as well, the numbers have been weak there, so look out for that too. While most of the Adani Group names have seen a Moody's upgrade, in terms of their rating. And Jefferies as well has initiated a buy on Adani Enterprises with a target price of 3,800. Enterprises holding up 1.25% in an otherwise weak market. What is Nalco up to? That's where the surprise has come in terms of earnings, and a positive one at that. A straight gap up move of 3.5% is what you're seeing on Nalco right now. A lot of other numbers, and let me read down the week list. There's Oil India, Gujarat Gas, Hindustan Copper. All these numbers have actually disappointed, and you can see red shades coming on most of these names. For Gujarat Gas, actually, it's quite a steep reaction. It's down 8% right now, after their EBITDA fell about 19%, and the volumes as well were below what the estimated average was. For Hindustan Copper as well, weak numbers. For Prestige Estates as well, there's been an EBITDA slip of 4%. The revenue is coming lower by 22.5%, 5.25% of a slash coming in for an otherwise extremely buoyant sector, that's real estate. But Prestige has fallen short of market expectations in terms of their numbers. Dredging costs